It's time for Physician Family Finances, the show where physician moms and dads like you can get the answers and encouragement you need to turn a good earned income into great life outcomes for tomorrow and today.
Hello, physician moms and dads. I'm Nate Reineke, certified financial planner and primary advisor here at Physician Family Financial Advisors. Thank you all for being here today for another episode with some great questions. I am running solo today. My other partners are out saving you money on taxes and writing you plans that help you feel secure, along with rebalancing your portfolio and all the other things we do behind the scenes. So it's just me today to answer your questions. I'm going to get started with one from a urologist in Maryland. They said, our practice is being purchased by private equity. Do you think we should take our payout in PE shares or cash? This is a tough question, mainly because there is some fear of missing out. That really is what it comes down to. And there's also some politics at play here. So whether or not you take the PE shares or not, when you're asking your colleagues what they did, or your new boss is wondering what you did, how much buy-in you have into the new practice, that all comes into play. But the reality is that PE equity is a liquid. It's also oftentimes leveraged, and it's obviously concentrated. So some of these deals do very well, but many are mediocre and some can even disappoint. So I would be cautious when considering whether or not to take this all out in stock or shares. The real reason not to take the shares is that, just like we talk about all the time on this show, we really value diversification. And this is about the furthest thing you can get away from diversification. Now, that being said, you were already concentrated in your practice and in this business, right? This was already a thing. You put a lot of your time, energy, blood, sweat, and tears, and money into your private practice. So the real question is, do you want to do this again? Or do you want to kind of cash in your chips? And I believe it is probably time at this point for a lot of people to cash in their chips. And that is just, from my perspective, the diversification is worth a lot. But the cool thing is, this is usually not an all or nothing deal. If equity is offered, you could easily say, I'll take some equity and a whole bunch of cash. You take enough equity sort of to benefit if things go up or if things go really well. And then you take a whole bunch of cash to where you're not left with regret if things don't go as well. I would ask you to ask yourself, if this were offered as a standalone investment, unrelated to your job, would you still decide to put this much money into it? Because many times the payouts are in the 7-figure range. And the person who asked me this question, it was the second payout, and both of them were about $500,000 each. So if you had $500,000 in cash, would you invest in this private equity firm? And it may seem like you wouldn't, because you haven't to this point. But remember that oftentimes this comes at a discounted rate. So you're getting these shares for a discount. There is a lot that goes into this. At the end of the day, I think a prudent investor would probably take most of the money in cash, depending on their stage in life. But taking a little bit of equity to continue to run your practice, it would not be a terrible choice either. Next question is from a psychiatrist in New Jersey. We are financially independent, but still working since we are in our mid-40s. We're considering shifting some money out of stocks and into bonds to get to a 60-40 portfolio. Is that a good idea for us? The fact that we're even asking this question makes me think this might be a pretty good idea. If you are financially independent in your mid 40s, it's pretty unique. That doesn't happen all that often, and it usually comes because you're not big spenders. So high earning physician, let's say you make 7, 800,000, maybe $1 million a year, but you spend like an average physician, maybe you spend $10,000 a month. That's a whole lot of saving. And if you just invested in a reasonable portfolio, you're going to have millions of dollars at this point. For this person, they had between 4 and 5 million at 45 years old and no intentions to spend a whole bunch more money. In fact, they like working. So the question is, should we buy more bonds? And I'll say I'm going to answer this question from the perspective of 60-40, but that is unique to each person. If you're 90-10 at 45 years old, if you're 90% stocks and 10% bonds, you don't have to shift all the way to 60-40, but maybe you shift to 80-20 or 75-25. You just make a shift toward bonds and potentially make a bigger shift toward bonds as you move forward. But as far as for this family, they asked about 60-40. I do tend to like a 60-40 portfolio. I was talking to Kyle about this question, and he calls this the all-weather portfolio. 60% stocks is enough stocks to outpace inflation and capture a decent amount of the returns in a well-performing stock market. But it also gives you a significant amount of capital preservation from a volatile stock market period. And that it's just performed really well in at least if you look at the history of the stock market with a 60-40 portfolio. When you're financially independent, you truly are. Your portfolio's job starts to shift from kind of being maximizing growth to really wanting to give you a high degree of reliability with your goals. And so you have to ask yourself this question: do I now value stability, and a reduction of volatility and sequence of returns risk? Do I start to value that more than I need growth? Because the only reason a sane person, I know we don't all do this, but the only reason the sane person takes any risk is if they need something for it, right? You wouldn't take risk if you didn't need it, right? It's not all of us do that, right? We get greedy or we make investment decisions off of fear. But, in a perfect world, we would only take risk we had to take. So the question is, if you don't have to take it, why are you? Well, that is unique to each person's plan. Okay. If you are saying I'm financially independent, but barely, you'd probably have room to take some more risk at 45 years old while you're still working. Right. If this family says I'm financially independent if I only spend $8,000 a month, but I'd sure like to spend 12, you have a reason to continue to invest slightly more aggressively or continue to save more money. There is many different combinations of decisions that come when you're making this decision about the 60-40 portfolio. For this family, though, they had plenty of money. They did not intend on spending a whole lot more. They loved work, and they really just wanted the stability. So they did move to 60-40. And I think that that will prove to be a portfolio that will give them peace and more stability for years to come than, let's say an 80-20 or a 90-10 portfolio. Okay, an ophthalmologist in Georgia. We have all the money we need to pay for college. Should I take our money out of the stock market? This is happening more and more lately, which is really encouraging. I see physicians that are actually prepared for college. So I'm sitting here and I'm imagining my children are 5 and 7. So I certainly don't have a full college fund yet. But I'm sitting here imagining, what if my oldest was 16 years old and I was a couple years ahead of the game, and I had a couple hundred or even several hundred and a 529 ready to pay for college. I've been saving for years and years and years. It's 10 years from now for me. and I have all the money I need. Should I continue to leave my money at risk? This kind of goes back to the 60-40 portfolio. Or should I take some risk off the table? So, the question is, take my money, take my gains, kind of lock them in, or eke out a few more dollars of return? And assuming that you, or the person asking this question, has planned correctly for high inflation, which the cost of college has, and you absolutely know you're ready to pay for college, I believe that it is better to lose some of the upside of being in stocks to gain some more certainty about being prepared to pay for this goal. Now, there's always some uncertainty about college. School choice, inflation is high, so you can't be completely certain about if you're ready, but you can be really close. And this is the time for this person to take risk off the table. Now, there's also something at play here that is interesting. I get this question every so often, and you realize when you really take a close look at these target date funds and 529s, you've already probably taken a ton of risk off the table. Most of your money is in bonds at 16 years old. So you be careful not to, assume that you're in all stocks and you need to take, you're taking a ton of risk. Most of the time at 16 years old, you might be 20% stocks. So that's a different question. Should you be all bonds? Should you be all money market funds? But realistically, for most people, they are right on track for college or slightly behind. And having some of your portfolio in stocks as you're leading into college would be okay as well. This is talking about someone who is fully prepared and wants no risk, no volatility. And for that person, I think you can make the choice to take all risk off the table. Last question is from Hand Surgeon in Florida. The surrender period of my variable annuity we purchased a while back is now ending. We were told that we're only paying 1% in fees on this account. Should we leave the money in the annuity? Oh, man. So this is interesting. You don't hear about annuities as often as used to, I would say. The end of a surrender period removes only one barrier to leaving money in annuity. But it doesn't necessarily mean that the annuity is a good sort of long-term hold. The things that factor into annuities are high fees. There's some tax consequences that are very unique to depending on which product you bought. So I won't get into those and whether or not you get rid of it or not. But there's high fees, and there are many times a hidden expense here that isn't actually an expense. So I'm going to jump into each one of these. And I want to be very careful here. The way I talk about annuities, sometimes it can sound like annuities are wrong for everyone. And that is certainly not the case. Annuities are wrong, I believe, for most physicians that we speak with, because the physicians that we speak with, they're not retired. They have plenty of savings, so they don't need this guaranteed return, and they don't need an allowance. Many times annuities can be for people who don't want to take any risk and they need an allowance. So just know that from the very beginning that I'm going to probably speak poorly about annuities, but that doesn't mean that they are a bad choice for everyone. So the first thing, only 1% in fees. That is rarely the case. It's rarely the full cost. I think when I was asked this question, there were some M&E fees that were 1%, but there's some kind of hidden fees here. There's sub-account expense ratio fees. Sometimes they're administrative fees. And costs with all of your investments are one of the very few controllable variables that you have. So that's why we care so much about cost. It's not that some investments aren't worth the cost. Many of them are, especially low-cost ETFs. But the reason we're so focused on them is just the one point of control that you have. You have investment selection and you have fees. It's like those are your choices here. So if you can control cost, you should. All right. So that's one big reason not to continue with a variable annuity, is that the ongoing fees are still rather high. And that doesn't account for the fees you paid up front or the fees you paid to get it into the annuity, because those are oftentimes very high. And the reason they are very high is because annuities come with a guarantee, a variety of guarantees many times. Sometimes annuities have just a guaranteed rate. You get 3% return, 4% return, whatever the guaranteed rate is. Other times, they come with a ceiling and a floor. So they're guaranteeing that you won't lose money. And by the way, annuities are sold by insurance companies. So an insurance company says, I'm going to take this risk away from you, and we're going to accept the risk. But in return, they want something. So you take no risk. The floor is 0%. You're not going to lose money. But what do they want in return? They want high fees, and they want your upside. So there is a cap on your returns. So let's imagine you're in an annuity and you have a 0% floor and a 5% cap, and you're tracking the S&P 500. So that means the rate of return you get goes up and down with the S&P 500, but there's a floor at 0 and a ceiling at 5%. That means if in a $1 million annuity, which by the way, that's how much this annuity was for, if the S&P 500 returns 15% and you only get 5, then that year, that annuity not only costs you 1% in M&E fees, plus sub-account fees, plus administration fees, but it also costs you $100,000 in missed opportunity. Now, that isn't a perfect example because you didn't take risk. So you don't get the 100,000 because you didn't take risk. So there is a trade-off here. But for many physicians that I know, that is not how this is sold to them. They look at it, it is sold by a slick salesperson looking for a high commission, and they're just uninformed about exactly the costs and the pros and cons of buying an annuity. And I just have yet to meet someone that once they hear all the pros and cons, they're all for putting a whole bunch of money in an annuity. And that is probably some self-selection because, the way I speak about them, so people come to me for advice about them because they kind of want to hear that they should get rid of it. But again, I will just say annuities are for some. I don't believe they're great for the vast majority of physicians. But that does not mean that if you have an annuity, it's the end of the world. Some are better than others. And there are ways to untangle them if you think that, you purchased one that you're not happy with. So you can always give us a call and we will work through it with you. So the question of should we leave the money in the annuity? Not because the surrender period is finished. That's not a good enough reason. You need to evaluate whether or not the fees and the guarantees are worth the actual cost. Thank you everyone for listening. If you liked this episode, please be sure to subscribe so you don't miss the release of new episodes. You can also leave us a rating wherever you are listening. If you'd like to work with us, you can visit physicianfamily.com, schedule an interview. And if you aren't ready for that, you can send us a question at podcast@physicianfamily.com. We'll answer every email we get, even if it doesn't make it on the podcast. Until next time, remember, you're not just making a living, you're making a life.
Are you ready to turn worries about taxes and investing into all the money you need for college and retirement? It's time to make a plan and get on track. To find out if we're a match, visit physicianfamily.com and click Get Started. Or you can ask a question of your own by emailing podcast@physicianfamily.com. See marketing disclosures at physicianfamily.com/disclosures.